How Wall Street profits from student loans. The intersection of Wall Street and student loans reveals a complex web of financial strategies and practices that profoundly impact borrowers. As student debt continues to rise, financial institutions have developed numerous ways to profit from the burgeoning market, often prioritizing their financial gains over the well-being of students. This article explores the top 10 ways Wall Street capitalizes on student loans, uncovering the mechanisms and consequences of their profit-driven approaches. Understanding these practices sheds light on the broader implications for borrowers and the student loan industry. Number 10. Securitization of student loans. Wall Street profits from student loans through the process of securitization, where student loans are bundled into securities and sold to investors. This practice converts student debt into tradable financial products, providing liquidity and generating returns for financial institutions. These securities are often structured into different tranches with varying risk levels, allowing investors to choose their desired risk and return profile. What if the very debt you carry could become a lucrative investment for Wall Street? The securitization of student loans enables banks to offload the risk of default while continuing to profit from the ongoing repayment of loans. This financial innovation creates a lucrative market for investors but often overlooks the long-term impact on students who remain burdened with substantial debt. Number 9. Interest rates and fees. The structure of student loan interest rates and fees significantly contributes to Wall Street's profits. Federal and private student loans often come with high interest rates and various fees, which generate ongoing revenue for lenders and financial institutions. Private loans in particular may have variable rates that can increase over time, leading to higher overall costs for borrowers. What if the costs associated with your education were designed to benefit Wall Street's bottom line? These financial products are structured to maximize profits for lenders through compounded interest and additional fees, often placing a significant financial burden on students. As a result, the long-term cost of education can be much higher than initially anticipated, contributing to Wall Street's substantial earnings. Number 8. Loan servicing and management. Wall Street firms also profit from student loan servicing and management. Companies that handle loan servicing earn fees from managing loans, collecting payments, and handling borrower inquiries. These servicers often charge fees for late payments, deferment, and forbearance, which can add up and further strain borrowers' finances. What if the management of your student loan was more about profit than helping you succeed? The servicing industry benefits from these fees and penalties, which contribute to Wall Street's revenue streams. Additionally, servicers may have little incentive to offer flexible repayment options or assistance, as their profitability is tied to collecting as much money as possible from borrowers. This financial dynamic underscores how the industry's focus on profit can impact borrowers' financial well-being. Number 7. Private loan origination. Private student loan origination is another avenue through which Wall Street profits. Financial institutions that offer private student loans charge origination fees and higher interest rates compared to federal loans. These fees are often substantial and can be added to the total loan amount, increasing the borrower's debt burden. What if a private loan you took out was designed to maximize Wall Street's gains? The higher interest rates on private loans can result in significantly more expensive long-term repayment compared to federal loans. This practice reflects the profit-driven nature of the private lending market and its implications for borrowers who may have limited access to affordable financing options. The profitability of private loans for Wall Street is maintained at the expense of increased financial pressure on students. Number 6. Default and collection practices. When borrowers default on their student loans, Wall Street firms often profit from aggressive collection practices. These practices can include high penalties, legal fees, and collection costs, which further increase the financial burden on borrowers. Collection agencies and debt collectors hired by lenders can impose additional fees and interest, compounding the amount owed. What if your financial struggles were a source of profit for Wall Street? The default process can lead to a cycle of debt, where borrowers face escalating costs and prolonged financial hardship. This aggressive approach to collections ensures that lenders and collection agencies continue to benefit financially, while borrowers suffer from intensified debt burdens and diminished financial stability. Number 5. Influence on legislation and policy. Wall Street's influence on legislation and policy related to student loans can also drive their profits. Financial institutions and investment firms often lobby for policies that favor their interests, such as higher interest rates or reduced borrower protections. These lobbying efforts can shape legislation in ways that enhance Wall Street's profitability while limiting relief options for borrowers. What if the policies governing your student loans were shaped to benefit Wall Street? The influence exerted by financial institutions can result in regulatory environments that prioritize their financial gains over the needs of students. This dynamic underscores the significant impact of Wall Street's lobbying on the structure and terms of student loan agreements. Number 4. Investment in education financial products. Investment firms invest heavily in education-related financial products such as student loan asset-backed securities and related derivatives. These investments are often structured to provide high returns, creating additional profit streams for Wall Street. By purchasing and trading these products, investors can capitalize on the steady income generated by student loan repayments. What if the financial products tied to your education were part of a lucrative investment scheme? The creation and trading of student loan-backed securities contribute to the broader financial market's profitability, with firms seeking to maximize returns from the education sector. This investment activity highlights the ways in which Wall Street capitalizes on the financial challenges faced by students. Number 3. Financialization of education. The financialization of education refers to the growing trend of treating education as a financial asset rather than a public good. Wall Street's involvement in this financialization process includes profiting from student loans, education bonds, and other related financial products. This shift towards viewing education through a financial lens influences how student loans are structured and managed, often prioritizing profit over accessibility. What if your education was seen primarily as a financial opportunity rather than a personal investment? The financialization of education leads to policies and practices that emphasize profitability, impacting the affordability and accessibility of higher education. This trend underscores the commercial interests driving the student loan industry and its effect on the educational experience. Number 2. Role of credit rating agencies. Credit rating agencies play a crucial role in Wall Street's profitability from student loans by assessing the risk and value of student loan-backed securities. These agencies assign ratings that affect the pricing and attractiveness of these securities to investors. Higher ratings can lead to increased demand and higher prices for these financial products, benefiting Wall Street firms. What if the rating of your student loan was more about maximizing Wall Street's profits than accurately reflecting risk? The ratings given to student loan securities influence investor decisions and impact the financial markets, with the potential for conflicts of interest affecting the accuracy of these assessments. This practice highlights the intersection of financial assessments and profit motives in the student loan industry. Number 1. Impact on borrowers' financial health. The ways in which Wall Street profits from student loans have significant implications for borrowers' financial health. High interest rates, fees, and aggressive collection practices contribute to a cycle of debt that can have long-lasting effects on students' financial stability. This debt burden can affect borrowers' ability to save for retirement, buy homes, or pursue other financial goals. What if the financial strain you face was a direct result of Wall Street's profit-driven practices? The long-term consequences of student loan debt are compounded by Wall Street's profit motives, which prioritize financial gains over the well-being of borrowers. This systemic issue underscores the broader impact of Wall Street's involvement in the student loan industry and its implications for individuals' financial futures. Thank you for tuning in. If you enjoyed the content, please hit the like button and subscribe to stay updated with our latest videos on YouTube.